If you have accumulated $1 million and you are over 60 years old, you have already won the game. You have done what most people never accomplish through decades of work, discipline, and sacrifice. You have built a nest egg that can provide security and comfort for the rest of your life. But here is the problem, that $1 million is now at more risk than ever before. Not because the world is more dangerous, but because the mistakes you make from this point forward cannot be undone. When you were 35 and made a bad investment, you had 30 years to recover. When you were 45 and the market crashed, you had time to wait it out. But now, in your 60s, every major mistake is potentially permanent. A 50% loss that a younger person can recover from over a decade might devastate your retirement. A bad bet on a speculative stock might cost you years of comfortable living. A wrong decision about asset allocation might force you to work longer than you planned or cut your lifestyle dramatically. I have spent a lot of time thinking about this problem. How do you protect wealth that took a lifetime to accumulate? How do you generate income from your savings without taking risks that could destroy them? How do you balance the need for growth against the need for safety when you no longer have decades to recover from mistakes? These are the questions that keep retirees up at night. And they are questions that the financial industry often answers poorly. The financial industry makes money from complexity. It makes money from trading. It makes money from selling products with high fees and commissions. It does not make money from telling you to buy treasury bills and hold them. So the advice you receive from most financial professionals is biased toward action, toward complexity, toward products that benefit the seller more than the buyer. This is not necessarily malicious. It is simply how the industry works. But it means that the advice most retirees receive is not optimized for their actual needs. I have watched this happen to people for over 70 years. Smart, successful people who built substantial wealth through their careers, only to watch significant portions of it evaporate because they did not adjust their approach for this stage of life. They kept taking risks that were appropriate for their 40s. They trusted advisors who put them in products designed to generate fees rather than safety. They chased yield without understanding the risks. They panicked during downturns and sold at exactly the wrong time. Today I am going to share with you the 4 rules I believe are essential for protecting a $1 million portfolio when you are over 60. These are not complicated rules. They are not secrets known only to Wall Street insiders. They are simple, proven principles that I have followed my entire career and that I believe are even more important for people protecting their retirement savings. If you follow these 4 rules, you will dramatically reduce your chances of making the catastrophic mistakes that destroy retirement security. Let me start by telling you a story that illustrates why these rules matter so much. I received a letter a few years ago from a man named Richard. He had retired at 62 with $1.2 million. He thought he was set. His advisor had put him into a portfolio of dividend stocks, high-yield bonds, and some alternative investments that promised steady income. On paper, Richard was generating about $80,000 per year from his portfolio. He was living well. Then 2022 arrived. Interest rates spiked. The bond market had its worst year in history. Several of Richard's high-yield holdings cut their dividends. His alternative investments, which he never fully understood, collapsed in value. By the end of the year, Richard's portfolio had fallen from $1.2 million to about $700,000. His annual income had dropped from $80,000 to under $40,000. At 66 years old, Richard was facing the prospect of going back to work or dramatically reducing his standard of living. He wrote to me asking what he should do. But by then, much of the damage was irreversible. Richard's story is not unusual. I hear versions of it constantly. People who accumulated significant wealth, who did everything right during their working years, who made catastrophic mistakes in retirement because they did not understand how the rules change when you are over 60 and depending on your savings for income. The 4 rules I am about to share are designed to prevent Richard's fate. They are designed to protect your $1 million through every market condition, every economic cycle, every crisis that might arise. Rule number one is never lose money. This might sound obvious, almost trivially simple, but it is the most important rule in investing and the one that people over 60 violate most frequently. When I say never lose money, I do not mean you should avoid all investments that might decline temporarily. I mean you should structure your portfolio so that you cannot suffer permanent catastrophic losses that impair your ability to live comfortably. I have said this for decades, and people often misunderstand what I mean. They think I am saying you should never have a losing investment. That is impossible. Every investor has losing positions. What I mean is that you should never put yourself in a position where a single bad outcome can permanently damage your financial security. You should never concentrate so heavily in one stock that its collapse ruins you. You should never use leverage that could force you to sell at the worst time. You should never invest money you need in the short term in volatile assets. Never losing money is about avoiding catastrophic, permanent losses, not about avoiding all temporary fluctuations. The mathematics of loss are brutal and unforgiving. If you lose 50% of your portfolio, you need a 100% gain just to get back to where you started. If your $1 million becomes $500,000, you need to double your money to recover. Then how long does it take to double your money? At 7% annual returns, it takes about 10 years. If you are 65 when you suffer that loss, 75 before you recover, assuming the market cooperates. That is 10 years of reduced income, 10 years of financial stress, 10 years of compromised retirement. Let me make this more concrete with an example. Suppose you have $1 million and you are 63 years old. You plan to withdraw $50,000 per year for living expenses. Here, if your portfolio earns 6% annually and you withdraw $50,000, your portfolio can sustain you essentially indefinitely. The math works. But now suppose your portfolio drops 50% to $500,000. If you continue withdrawing $50,000 per year, that is a 10% withdrawal rate. Even if your investments earn 6%, you are depleting your principal by 4% annually within 15 years. You run out of money, you are 78 years old and broke. That is the mathematics of loss for retirees. It is not about the stock price recovering eventually. It is about running out of money before you run out of life. But the damage is often worse than just the mathematics suggest. People who suffer large losses tend to make emotional decisions that compound the damage. They sell at the bottom, locking in their losses. They become so risk-averse that they miss the recovery. They abandon their investment strategy at exactly the wrong moment. The psychological damage of a large loss can be as harmful as the financial damage. How do you implement this rule? By being ruthlessly honest about what you can afford to lose and structuring your portfolio accordingly. If losing 30% of your portfolio would force you to change your lifestyle dramatically, then you should not have more than a small portion of your money in investments that can decline 30%. If losing 50% would be catastrophic, then you should avoid volatile investments almost entirely. For most people over 60 with $1 million, this means keeping the majority of your portfolio in safe, stable investments, treasury bills, and short-term treasury notes, high-quality dividend stocks with long track records, cash in FDIC-insured accounts. These investments might not generate the highest returns, but they will not destroy your retirement either. The goal is not to maximize returns. The goal is to avoid catastrophic losses that cannot be recovered. I have followed this rule my entire career. At Berkshire Hathaway, we keep enormous amounts of cash on hand, currently over $325 billion. Critics say we are being too conservative, that we are missing opportunities. But that cash means we never have to sell investments at bad times. We never have to make desperate decisions. We can survive any crisis and emerge stronger. The same principle applies to your personal portfolio. Safety first, returns second. Rule number 2 is understand what you own. This rule sounds simple, but it is violated constantly by investors of all ages, and the consequences for people over 60 can be devastating. If you cannot explain in plain English why you own an investment and how it makes money, you should not own it. Period. No exceptions. The financial industry loves complexity. It creates products with impressive sounding names and intricate structures, structured notes, collateralized loan obligations, principal, protected securities, alternative investment funds, hedge fund of funds, private credit vehicles, non-traded REITs. The alphabet soup of financial products gets longer every year. These products are often marketed to retirees as safe, high-income investments. The salespeople use jargon that sounds sophisticated. The brochures are glossy and professional. The promised yields are attractive. But underneath the complexity, these products often carry risks that are not obvious until it is too late. I have a very simple test that I apply to every potential investment. Can I explain this to a smart teenager? Can I describe how the business makes money, what its competitive advantages are, what could go wrong, and why it is a good value at the current price? If I cannot pass this test, I do not invest, no matter how attractive the opportunity seems. This simple test has protected me from countless disasters over my career. I learned this lesson early in my career, and I have never forgotten it. I do not invest in things I do not understand. I do not care how smart the people are who created the product. I do not care how impressive the past returns look. I do not care how many other people are investing in it. If I cannot understand it, I do not buy it. This simple rule has protected me from countless disasters over the decades. Think about what happened in 2008. Millions of investors owned mortgage-backed securities that they did not understand. They trusted the ratings agencies. They trusted their advisors. They trusted the impressive sounding institutions that created these products. And they lost fortunes when the housing market collapsed and these securities became worthless. The people who avoided these losses were not smarter or luckier. They simply followed the rule of only owning what they understood. For people over 60, this rule is especially important because you do not have time to recover from mistakes. If a 30-year-old buys a complicated product that blows up, they learn an expensive lesson, move on. If a 65-year-old buys that same product, it might permanently impair their retirement. The stakes are simply too high to own things you do not understand. What should you own instead? Simple, transparent investments with long track records. Index funds that own hundreds of stocks and have been around for decades. Individual stocks of companies whose businesses you can explain to a child. Treasury securities backed by the United States government. These investments might seem boring compared to the exotic products Wall Street wants to sell you. But boring is beautiful when your retirement security is at stake. Let me give you a practical test for every investment in your portfolio. Write down in one paragraph what the investment is, how it makes money, and what could cause it to lose value. If you cannot do this clearly and confidently, you should not own that investment. Sell it and replace it with something you understand. Rule number 3 is keep enough cash to survive any crisis. This rule is about liquidity, about having money available when you need it without having to sell investments at bad times. For people over 60, this is not just good practice. It is essential for financial survival. Life is unpredictable, especially as you get older. Medical expenses arise unexpectedly. Home repairs become necessary. Family members need help. Cars break down, roofs leak. 1,000 things can happen that require immediate access to money. If all your money is tied up in investments, you might be forced to sell at exactly the wrong time to meet these needs. I want to emphasize something about why this rule is so important, specifically for people over 60. When you are younger, you can often handle unexpected expenses by earning more money. You can work overtime, you can take a second job, you can ask for a raise. But when you are retired or near retirement, these options are limited or unavailable. Your investment portfolio is your primary financial resource. If you are forced to liquidate investments at bad prices to meet unexpected expenses, you are permanently impairing the asset base that you depend on for the rest of your life. There is no making it back through additional work. Think about what happened in March of 2020. The stock market crashed over 30% in just a few weeks as COVID fears spread. Many investors needed cash for various reasons. Lockdowns, job losses, family emergencies. Those who had adequate cash reserves could meet their needs without selling investments. Those who did not have cash were forced to sell stocks at the bottom, locking in devastating losses and missing the recovery that followed. I have seen this pattern in every single crisis throughout my career. In the 1974 bear market, people sold at the bottom. In 1987, people sold at the bottom. In 2002, people sold at the bottom. 2008 and 2009, people sold at the bottom. In 2020, people sold at the bottom. The pattern is always the same. People without liquidity are forced to sell when they should be holding or buying. People with adequate cash reserves can wait for recovery and often buy more at depressed prices. This scenario repeats in every crisis. In 2008, people sold at the bottom because they needed cash. In 2002, people sold at the bottom because they needed cash. Every time there is a market crash, the people without adequate liquidity suffer the most. They are forced to sell low, violating the most basic principle of investing. How much cash should you keep? I recommend at least 1 year of living expenses and preferably 2 years in completely liquid form. This means savings accounts, money market funds, or treasury bills that mature within a few months. This cash should be separate from your investment portfolio. It is not earning high returns, and that is fine. Its purpose is not to generate returns. Its purpose is to provide security and flexibility. 2 years of living expenses might sound like a lot to keep in cash. Financial advisors will tell you that you are losing money to inflation, that you should have that money invested, that cash is a drag on returns. Do not listen to this advice. The peace of mind that comes from having adequate cash reserves is worth far more than the extra return you might earn. The ability to survive any crisis without selling investments is priceless. Let me tell you what happened to a friend of mine during the 2008 crisis. He was 63 years old with about $800,000 in investments. He had almost no cash because his advisor had convinced him to be fully invested when the market crashed. His portfolio fell to under $500,000. Then his wife needed surgery that cost $50,000 out of pocket. He had to sell stocks at the bottom to pay for it by the time the market recovered. His portfolio was worth only about $400,000. He never recovered financially. He spent the rest of his retirement worried about money. Compare that to another friend who had the same amount invested but kept $150,000 in cash. When the crisis hit, his investments fell too, but he did not have to sell anything. He used his cash for expenses and waited for the recovery within a few years. His portfolio had fully recovered. He spent his retirement comfortably without financial stress. The only difference between these two outcomes was adequate cash reserves. Rule number 4 is do not try to outsmart the market. This rule is about humility. It is about recognizing that the market is smarter than any individual investor, and that trying to time the market or pick the next hot stock is a losing game for most people, especially for people over 60 who cannot afford to be wrong. The financial industry wants you to believe that with the right information, the right advisor, the right strategy, you can beat the market. They sell newsletters promising stock picks that will double your money. They sell trading systems that claim to time the market perfectly. They sell access to expert stock pickers who will generate superior returns. Almost all of it is nonsense. Study after study shows that the vast majority of professional money managers fail to beat a simple index fund over long periods. If the professionals cannot do it consistently, what chance do you have? Let me share some numbers that might surprise you. Over a 15-year period, approximately 92% of actively managed large cap funds underperform the S&P 500 index. Over 20 years, it is even worse. These are professionals with teams of analysts, access to company management, sophisticated computer models, and decades of experience, and over 90% of them fail to beat a simple low-cost index fund. If the best and brightest on Wall Street cannot consistently beat the market, the idea that you can do it with a few hours of research per week is fantasy. This is not an insult. It is simply reality. The market is incredibly efficient at incorporating all available information into prices. By the time you hear about a great investment opportunity, the opportunity has usually already been priced in. By the time you decide to sell because you think the market is going to crash, millions of other investors have already had the same thought. You are not smarter than the collective wisdom of the market. Neither am I. Neither is anyone. I want to be clear about what I mean here. I am not saying that no one can ever beat the market. I have spent my career picking stocks, and I have done reasonably well, but I have also spent 70 years developing the skills to do this. I read 500 pages a day. I have analyzed thousands of businesses. I have made investing my life's work. For someone who is not willing to make that kind of commitment, trying to pick individual stocks or time the market is likely to produce worse results than simply owning an index fund. For people over 60, the temptation to outsmart the market often comes from a dangerous place. You look at your portfolio and worry that it is not growing fast enough. You hear about people making fortunes in the latest hot sector. You see stocks doubling and tripling, and you wonder why you are not participating. So you take a flyer on a speculative stock. You try to time the market by moving in and out of stocks. You chase performance by buying whatever did well last year, and usually you lose money. I have seen this pattern destroy retirement portfolios countless times. Someone has a solid $1 million portfolio generating reliable income. Then they get greedy. They put $100,000 into a hot tech stock because they heard it was going to the moon. The stock crashes 70%. Now they have lost 10% of their portfolio on a single bad bet. They try to make it back by taking another risky bet. That one fails too. Within a few years, their solid $1 million portfolio has become a struggling $600,000 portfolio, all because they tried to outsmart the market. The solution is to embrace simplicity and humility. Own a diversified portfolio of index funds and high-quality dividend stocks. Do not try to pick winners. Do not try to time the market. Do not chase performance. Just own the market through low-cost index funds and let the long-term growth of American business work for you. This approach will not make you rich quickly, but it will not make you poor either. And for someone over 60 with $1 million, not getting poor is far more important than getting richer. Let me now talk about how these 4 rules work together to protect your portfolio. Each rule reinforces the others. Never losing money means owning simple, understandable investments, which means you do not need to outsmart the market, which means you can keep adequate cash because you are not chasing returns. The rules create a coherent philosophy of capital preservation that is perfect for people over 60. Here's how I would structure a $1 million portfolio using these 4 rules. First, I would keep $200,000 in cash and short-term treasury bills. This covers approximately 2 years of living expenses for most retirees and provides a fortress of liquidity that can survive any crisis. This money earns 4 to 5% in the current environment, which is meaningful income with zero risk. Second, I would put $500,000 in short-term treasury securities with maturities of 1 to 3 years. These provide excellent income with no risk to principal. At current yields of 4 to 5%, this allocation generates $20,000 to $25,000 annually. Combined with the cash allocation, you have $700,000, 70% of your portfolio in completely safe investments. Third, I would put $300,000 in a diversified portfolio of dividend-paying blue-chip stocks or a low-cost dividend ETF. This provides exposure to the growth of American business, inflation protection through rising dividends, and additional income of perhaps $8,000 to $10,000 annually. This allocation carries more risk than treasuries. but it is only 30% of the portfolio, limiting the damage if stocks decline. This portfolio would generate approximately $50,000 to $60,000 in annual income, which is a 5 to 6% yield on your $1 million. It would be highly stable because 70% is in safe fixed income investments. It would provide growth potential through the stock allocation, and it would have ample liquidity to survive any emergency without selling investments at bad times. Is this the optimal portfolio for maximum returns? Absolutely not. A younger investor might have 70% in stocks instead of 30%. But this portfolio is not designed for maximum returns. It is designed for maximum security. It is designed to protect your $1 million through every market condition while generating reliable income. For someone over 60, that is exactly the right goal. Some people will look at this portfolio and think it is too conservative. They will point out that they could earn higher returns with more aggressive allocations. They are correct. Over long periods, a portfolio with more stocks will likely generate higher returns, but that higher return comes with higher risk. And for someone over 60, that higher risk can be fatal to retirement security. Let me put it this way. If you have enough money to live comfortably with a conservative portfolio, why take unnecessary risk? What exactly are you trying to achieve if you already have enough? The rational thing to do is protect what you have, not gamble it away trying to get more. The only people who should take significant risk with their retirement savings are those who do not have enough and have no other choice. If you have $1 million and can live on $50,000 to $60,000 per year, you have enough protected. Let me address some objections to this conservative approach. Some people say that with life expectancies increasing, people over 60 should still invest aggressively for growth. They argue that you might live another 30 years and need your portfolio to keep growing. There is some truth to this argument, but it misses a crucial point. The risk of running out of money because your portfolio crashed is far greater than the risk of running out of money because your portfolio grew too slowly. A conservative portfolio that generates 5% annually will sustain most retirees comfortably. A portfolio that crashes 50% might never recover. Some people say that keeping so much in cash and treasuries means losing money to inflation. This concern is valid over very long periods. But in the current environment, with treasury yields of 4 to 5% and inflation running at 2 to 3%, you are actually maintaining purchasing power with some margin of safety. And even if inflation does erode some value over time, that is far better than watching half your portfolio evaporate in a market crash. Some people say they need more income than this conservative approach provides. If $50,000 to $60,000 annually is not enough, you have options. You could reduce your expenses. You could work part-time to supplement your investment income. You could draw down principal gradually, understanding that this will eventually deplete your savings. What you should not do is reach for higher yield by taking on more risk. That is how retirees destroy their portfolios. Let me close with some thoughts on the psychology of protecting wealth. The hardest part of following these 4 rules is not intellectual. The rules are simple to understand. The hard part is emotional. It is watching your neighbors talk about the killing they made in some hot stock while your boring portfolio just plods along. It is resisting the fear of missing out when everyone seems to be getting rich except you. It is staying calm when the market drops and the television is full of predictions of doom. I want to share something I've observed over 70 years of investing. The successful investors I know, the ones who build and preserve wealth over decades, are not the smartest people. They are not the most sophisticated. They are not the ones with the best information. They are the ones with the right temperament. They are patient. They are calm. They do not get swept up in manias or panics. They make a plan and they stick to it through thick and thin. Temperament beats intelligence in investing almost every time. The people who successfully protect their wealth in retirement share certain characteristics. They are patient. They are disciplined. They are humble about what they do not know. They focus on their own financial security rather than comparing themselves to others. They understand that boring is beautiful when your lifestyle depends on your portfolio. They do not need to brag about their investment returns because they have something better. Peace of mind. Think about what you actually want from your $1 million. You want it to be there when you need it. You want it to generate enough income to live comfortably. You want to sleep well at night without worrying about your investments. You want to leave something to your children or grandchildren. You want freedom from financial anxiety. None of these goals require beating the market. None of them require taking big risks. None of them require sophisticated strategies. They require following 4 simple rules and having the discipline to stick with them. I have been investing for over 70 years. I have seen every type of market. I have watched fortunes made and fortunes lost. And I can tell you with certainty that the people who follow these 4 rules, who never lose money, who understand what they own, who keep adequate cash, and who do not try to outsmart the market, almost always end up fine. They sleep well at night. They do not worry about money constantly. They enjoy their retirement because they have built a financial foundation that can survive anything. Your $1 million represents decades of work and sacrifice. It represents thousands of hours of labor, countless decisions to save rather than spend, years of discipline and patience. It represents missed vacations and deferred gratification and all the things you did not buy so that you could have security in your later years. Do not squander it now by violating these rules. Protect it, preserve it, let it provide for you for the rest of your life. That is what it is for. That is what you earned. And these 4 rules will help you keep it safe and secure for as long as you live. Never lose money. Understand what you own. Keep enough cash. Do not try to outsmart the market. Follow these rules and your $1 million will take care of you.